This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook. And, I mean, just imagine 13 trillion yen for a second.
That is, yeah, that's a massive amount of capital.
Right. It's enough to just outright buy several major global corporations. And that exact amount of cash is basically being dropped directly into a Japanese stock market that's, well, it's teetering on a pretty sharp geopolitical knife's edge right now.
Exactly.
So, yeah, that is the unprecedented scenario unfolding in Tokyo this week. We're doing a deep dive into the market outlook for the week of June 1st to June 5, 2026. Because we have this historic Nikkei high, a super volatile dollar-yen, and they are about to just collide head-on with a brutal gauntlet of U.S. economic data.
Yeah, it's really the perfect storm. The Japanese market right now is basically suspended between these two incredibly powerful, totally opposing forces.
Okay, tug-of-war.
Right, exactly. So on one side, you have this absolute ocean of domestic liquidity that's ready to deploy. But then on the other side, there's this huge overarching fear about U.S. interest rate shifts and, Middle East instability.
Which could change everything.
It could rewrite the global cost of capital overnight, literally overnight. So our objective for you today is to map out the mechanics behind these forces. That way, you can actually anticipate the volatility this week instead of just, reacting blindly to it.
Yeah, let's start by looking at the sheer scale of the domestic equities landscape, because the numbers we're seeing are just historic.
Oh, absolutely.
I mean, the Nikkei surged past the 66,000 mark for the first time on a closing basis. It ended the week at 66,329.50.
Right.
That is a jump of nearly 2,990 points from just the previous weekend. And the 2px is sitting right up there in 3,957.17.
Okay.
So when we look at what's actually driving this, it seems like two main narratives are dominating.
Yeah, mainly two.
The broadening of the AI boom and this really aggressive pricing in of Middle East stabilization.
That's spot on. And, the AI narrative has evolved so much from previous years. We aren't just looking at, a handful of giant semiconductor companies pulling all the weight anymore.
Right, it's bleeding into other sectors.
Exactly. The capital is broadening out all the way down the supply chain. So we're seeing it hit power infrastructure, specialized cooling systems, even secondary tech components. And that creates this really deeply entrenched buy-on-the-dip reflex among institutional investors.
You just buy any slight drop.
They do. And simultaneously, you have these algorithmic trading models that have basically fully priced in the normalization of the Strait of Hormuz within the next few months.
Really?
Yeah, they're just assuming that the geopolitical supply chain shocks are going to fade away completely.
Okay, well, I have to challenge that premise a bit, especially when you look at the institutional investor survey data coming out from the major U.S. banks. The data shows this massive, really aggressive shift of institutional money out of cash and straight into equities. I mean, the sentiment index shows that bearish sentiment and the pessimistic side of the market has basically been wiped out to zero.
It's virtually gone, yeah.
Right. So if every single institutional player is already fully invested, totally bullish, doesn't that mean the market is priced for absolute perfection? I mean, isn't everybody rushing to one side of the boat?
Yeah.
Doesn't a zero bearish environment actually serve as a severe structural vulnerability?
It absolutely does. It creates a highly, highly fragile algorithmic environment. Because, like you said, when a market is priced for perfection, your margin for error is exactly zero.
Right. There's no cushion.
None. So any data point that deviates even slightly from that optimistic baseline, it doesn't just cause a slight pullback, it triggers these automated cascading sell-offs.
Wow.
Yeah. And that baseline assumption that the Strait of Hormuz is just going to normalize smoothly, that's a massive vulnerability.
Because if it doesn't.
Right. If that timeline drags out, you get persistent oil concerns. And those feed directly into sticky inflation. And sticky inflation forces the Federal Reserve's hand,
pushing them toward a reactive rate hike.
Exactly. And the second that bond yields spike in response to a potential FRB hike, the valuation models for all those high-flying AI equities, they just break down. The capital immediately rotates out.
Got it. Which brings us, I guess, to the ultimate counterweight here. That 13 trillion yen safety net that I brought up at the top of the deep dive.
Yes, the dividend payouts.
Right, because June is the month when corporate dividends from the end of March are actually physically paid out to shareholders in Japan.
And the mechanics of this specific payout are crucial if you want to understand the market floor for this week.
Okay, break that down for us.
Well, we're looking at an estimated 13 trillion yen flowing back directly to investors. And historically, institutional algorithms and pension funds are actually mandated to systematically reinvest a massive chunk of these payouts straight back into domestic equities.
Wait, mandated, so it's not even a choice.
Exactly. This isn't speculative buying, it's structural rebalancing. So this massive wave of forced reinvestment creates a huge bid right beneath the market.
Oh, I see.
Yeah, it basically functions as a giant shock absorber against any external volatility.
Okay, but let's test the strength of that floor for a second. Let's say Friday's U.S. jobs report comes in red hot, right?
Mm.
And the FRB suddenly signals a rate hike.
Okay.
Wouldn't foreign capital just immediately pull out of Japanese equities looking for higher yields in the U.S.? Like, can 13 trillion yen in domestic dividend reinvestment actually hold the line against a massive sudden outflow of foreign money?
That's the big question. It basically becomes a battle of attrition at that point because the domestic dividend reinvestment is very mechanical, it's steady,
Right.
but foreign capital flight is immediate, it's aggressive. So if a U.S. rate shock happens, that 13 trillion yen isn't going to magically prevent the Nikkei from dropping.
It'll still fall.
It will, but the domestic money will drastically slow the velocity of that descent. Basically, it changes what could be a full-blown market crash into a managed, orderly correction.
Okay, that makes sense.
So based on that friction, the domestic safety net pushing up, and the looming geopolitical risks pushing down the technical forecast range for the Nikkei this week sits between 63,000 and 68,000 yen.
Got it. So the high end is capped by those stretched AI valuations,
Right.
and the low end is defended by that dividend rebalancing.
You nailed it.
Well, that friction between domestic Japanese capital and U.S. rate fears, it naturally bleeds straight over into the foreign exchange market, doesn't it?
Oh, absolutely.
Because the volatility we're seeing in the U.S. dollar-yen pair right now, it's basically a real-time stress test of everything we just talked about.
It really is.
We just watched the pair break right through the 159 mark. I mean, it hit a weekly high of 159.65 right after reports of military clashes between the U.S. and Iran started circulating.
Yeah, and the mechanics behind that specific surge are totally rooted in what we call emergency dollar buying. Because in moments of acute geopolitical escalation, algorithms and macro funds, they immediately seek out the ultimate safe haven liquidity, and that is always the U.S. dollar.
So they just dump everything else.
Exactly. Capital flees from emerging markets, it flees from riskier assets, and it just piles straight into the greenback. That drives the dollar's value sharply up against the yen, totally irrespective of any domestic Japanese economic data.
You know, watching it approach 160, it really feels like watching traders slowly approach this invisible electric fence.
That is a great way to put it.
Right. Because the Japanese government and the Bank of Japan, they did that massive intervention back on April 30, and that established this hard psychological boundary just above the current market level.
Very hard boundary, yeah.
So every time traders try to push the dollar up toward that 159.65 mark, the algorithmic buying just dries up. Because, I mean, nobody wants to be the guy holding the bag if the Ministry of Finance decides to step in and shock the system again.
Nobody at all. And the memory of that April 30 intervention has created some really heavy options barriers right below the 160 level.
So they're actively defending it.
Yeah, traders are actually actively selling the dollar and buying yen the second it approaches that threshold, just purely out of risk management.
Wow.
But, what makes this week particularly volatile is the wild card that could just drop the floor out from under the dollar entirely.
Oh, right. The Iran ceasefire talks.
Exactly. The potential final agreement between the U.S. and Iran regarding a 60-day ceasefire extension and a new memorandum on Iran's nuclear program.
Which is huge. But the reporting right now suggests the deal is actually still pretty distant, right? Like mostly tentative agreements at the lower diplomatic levels, but no real cabinet-level consensus yet.
That's true. It might be distant, but the market still has to price in the probability of a sudden announcement. Because if a dramatic final ceasefire agreement actually gets signed,
The emergency dollar buying stops.
it instantly reverses. That geopolitical safe haven premium that's built into the dollar right now would unwind in a matter of hours. And that would send the USD-JPY pair just plummeting down toward its technical support levels.
Unbelievable. Okay, so taking into account that invisible electric fence on the upside at 160, and then the risk of a ceasefire completely unwinding the dollar premium on the downside, the expected range for the dollar yen this week is set between 155.00 and 161.00.
That's the range. And that 155.00 level is really the critical line in the sand there.
Why is that?
Because it aligns almost perfectly with the 200-day moving average. And that's a major technical support line where systematic trading algorithms will just naturally step in to buy.
Okay, so we have the playing field established for you. 63,000 to 68,000 for the Nikkei and 155 to 161 for the dollar yen.
Right.
But navigating these technical levels requires a really exact map of the week's data catalysts. Because every single day this week features economic stress tests that will either, validate or totally shatter those technical.
Every single day, yeah.
And it all builds up to this massive test of the U.S. economic engine on Friday. So let's break down the mechanics of this week's timetable, starting with Monday, June 1st.
Okay, so Monday morning really establishes the localized health of the Japanese economy. At 8:50 a.m., the Q1 corporate statistics drop.
Okay.
And what you should be looking for here isn't just the top-line profit numbers. You need to look at capital expenditure.
So are they actually spending their money?
Exactly. Are Japanese companies actually reinvesting their cash reserves into facilities and equipment? Because that signals long-term confidence.
Got it.
Then moving into the global sphere at 10:45 a.m., we get China's May Rating Dog Manufacturing PMI.
And I always find that Rating Dog PMI super fascinating because it focuses heavily on the smaller and medium-sized enterprises in China, right?
Yes, exactly.
Rather than just the massive state-owned giants that get covered in the official government reports.
Right.
So it gives a much more accurate kind of ground-level read on global supply chain health, which directly impacts Japanese exporters.
Absolutely. It's a much cleaner signal. And then later on Monday, we see the Eurozone April unemployment rate at 6.00 p.m., followed by the first really major U.S. stress test at 11.0 p.m., which is the U.S. May ISM Manufacturing Index.
And why is that one the major test?
Well, the U.S. ISM Manufacturing Index is crucial because the FRB actually uses it as a forward-looking indicator.
Oh.
We aren't just looking at the headline number. The internal metrics, specifically new orders versus prices paid. Those will tell us if manufacturing is cooling down while input costs are staying stubbornly high.
Which would be the textbook definition of stagflation pressure.
Precisely. Stagflation is the nightmare scenario.
Okay, so that brings us to Tuesday, June 2. And this is where the focus sort of shifts back toward the Bank of Japan and their stealthy policy maneuvers, right?
Yes, stealthy is the right word.
At 8:50 a.m., we get the main monetary base and a highly anticipated 10-year government bond auction.
And you really need to watch that bond auction. It is far more than just a routine debt issuance.
Really? Why?
Because the BOJ has been subtly signaling a reduction in their monthly bond purchases. So this auction is going to reveal the market's true appetite for Japanese debt without the central bank artificially pinning the yields down.
Oh, wow. So if demand is weak.
If demand is weak, yields will tick upward pretty fast, and that will heavily impact domestic bank stocks.
Okay, definitely something to watch.
Oh.
And then later Tuesday night at 11:00 p.m., the U.S. releases the April JOLTS job openings.
Right.
And we already know JOLTS tracks available jobs, but the vital metric to dissect here is the quits rate, and specifically the openings in the services sector.
Yes, services are key.
Right, because if hospitality and healthcare are still desperately trying to hire, they have to raise wages. And that wage growth is the exact sticky inflation keeping the FRB hawkish.
Exactly right.
We also see earnings from Palo Alto Networks on Tuesday, which will basically serve as a proxy for corporate IT and cybersecurity spending.
Good proxy to watch. And then we hit Wednesday, June 3, which is just an absolute data gauntlet.
Oh, boy.
Yeah. Domestically, BOJ Governor Ueda is scheduled to give a speech. Now, the market is not expecting any actual policy changes, but algorithmic language processing tools will be scrutinizing every single syllable he says.
So literally parsing his words in real time.
Literally. If he shifts his phrasing from, say, maintaining an accommodative environment to being vigilant to upside inflation risks, the yen will react immediately.
Just off a slight word change.
Yeah. Also, notice that the Korean markets are actually closed on Wednesday.
Oh, right.
Which means Asian trading volume might be quite a bit thinner, and that naturally increases volatility.
Got it. And then the U.S. data drops on Wednesday night are the true heavyweights.
They are.
At 9:45 p.m., the May ADP employment report gives us an early read on private payrolls. And then at 11:00 p.m., the May ISM non-manufacturing index drops.
Which is huge.
Because the U.S. economy is overwhelmingly service-based, right?
Yeah.
So this index is a much more accurate reflection of the inflationary pressures average Americans are facing compared to the manufacturing data we see on Monday.
That's exactly right. And moving into early Thursday morning, right around 3:00 a.m., the FRB releases the Beige Book.
The Beige Book.
Yeah, which is basically this collection of anecdotal reports from bank directors and business contacts across all the different reserve districts. Traders love to use it to spot localized credit crunches or supply bottlenecks way before they show up in the hard macroeconomic data.
That's super smart.
And Wednesday also delivers a barrage of massive corporate earnings. You've got Broadcom, CrowdStrike, Medtronic, and over in Europe, Inditex.
That is a lot for one day. I mean, the sheer volume of Wednesday's data makes Thursday, June 4, look like a brief opportunity to just finally breathe.
Seriously.
The primary notable event on Thursday is really just earnings from Sekisui House in Japan.
Right.
But as a major home builder, their margins will act as a pretty great real-world proxy for whether domestic companies can successfully pass on these rising materials and labor costs directly to the Japanese consumer.
Yeah, that's a crucial domestic indicator.
Which sets the stage for the ultimate catalyst on Friday, June 5.
The crescendo of the week. So Friday morning starts with a major reality check for the Bank of Japan. At 8:30 a.m., we see the April monthly labor statistics and the household spending data.
The Shunto results, right?
Exactly. The BOJ has been heavily counting on those historic spring wage negotiations, the Shunto, to finally spark a virtuous cycle of domestic spending.
Right.
So this household spending report is going to prove whether those wage increases are actually translating to the real economy or if Japanese consumers are just, hoarding their cash because they're terrified of inflation.
Interesting. Then we look toward the Reserve Bank of India policy meeting and their Q1 GDP release at 7:30 p.m.
Right.
Which is an important health check for one of the key alternative growth engines in the Asian market right now. But let's be real, the entire week ultimately builds toward 9:30 p.m. on Friday night, the U.S. May jobs report.
That is the main event. The mechanics of this entire week basically hinge on this singular report.
Everything.
Everything we've discussed today, the ISM data, the ADP numbers, the JOLTS sector analysis, they are all just breadcrumbs leading up to the non-farm payrolls. This report alone will strictly dictate the FRB's perception of the economy.
Okay.
If wage growth and hiring remain too hot, the FRB will be forced to maintain high interest rates, period. But if the labor market is finally starting to crack under the weight of current policy, they might actually hint at rate cuts.
So the results of that U.S. jobs report act as the ultimate lever.
The ultimate lever.
That single data point will either validate the U.S. dollar strength, testing the BOJ's invisible electric fence at 160, or it will cause the dollar to just crater toward 155.
Yes.
It will either justify the high valuations of the AI tech sector, or it'll cause a sudden spike in bond yields that totally test the floor of the Nikkei's 66,000 level.
Exactly.
Friday night is the culmination of all the friction we've mapped out today.
It really is. And the Japanese market is uniquely positioned to absorb these shocks right now, mostly because it's supported by that staggering 13 trillion yen in structural dividend reinvestment.
Right, the massive floor.
But as you watch these geopolitical negotiations and the domestic policy shifts and the crucial U.S. economic indicators unfold day by day this week, you just have to recognize that the safety net is suspended over a very precarious global foundation.
Yeah, it is a remarkable structural balancing act. I mean, you have this massive domestic liquidity actively battling against the omnipresent risk of a sudden shift in global interest rates and Middle East conflict.
And consider this as the week unfolds for you. If that systematic 13 trillion yen reinvestment machine collides head-on with a massive surprise spike in U.S. bond yields following Friday's jobs report.
Oh, man.
How will a stock market that is currently completely devoid of bearish sentiment react to an unexpected overnight change in the global cost of capital? Because when the margin for error is zero, even the strongest safety nets are pushed to their absolute limits.
A fascinating stress test for a historic market. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.